Welcome to A Canadian Investing in the U.S., a podcast and YouTube channel focused on Canadians buying real estate with host Glenn Sutherland.
Welcome to a new episode of Canadian Investing in the U.S. with Glenn Sutherland. This week, my guest is Mathew Owens. Mathew, for people who don't know who you are, let's maybe just do a little bit of background, maybe a story, how you do what you do, and yeah, let's get into this.
Awesome. Sounds great, man. I appreciate you having me on. Looking forward to adding some value to everybody here. So I'm a CPA. I grew up in Southern California and got a degree in economics with an emphasis in accounting and became a CPA thereafter, working at different CPA firms and just being bored out of my mind, of course, because you're dealing with taxes and audit the entire time. And I just wanted something different. And I started looking at real estate and started getting some education on real estate and literally got my first deal under contract in 2006, and I was going to make 30 grand on a flip, and I was like, I quit. I'm out of my job. I can't deal with this anymore. My mind was gone. I was just focused on how do I make more money, and I really didn't know what to do at first until real estate kind of fell on my lap, and I became really interested in the strategies and structures that I was learning through the education, and started in how to build wealth outside of the normal Fidelity check a box stuff, the mutual fund stuff, right? And I really, even as a CPA, was never knowledgeable about that or never got taught that kind of stuff on the financial education side. It was all just monotonous tax work and things like that. Luckily, it was working on on real estate clients too, so I kind of already had an understanding to a degree, even though I was not aware at the time that I had that understanding, right? So, but I got my first deal. We ended up making 20 grand on that flip. And then my stepbrothers and I went into business together. They're computer programmers, and I'm a CPA, and I'm supposed to be the one that can talk to people, of course, and have the personality, right? And it was not happening at the time, but we started flipping houses very quickly, actually, where all our efforts combined, we're flipping about 5 a month consistently. And then the market tanked, and, we thought we were real estate geniuses, and then took a massive punch in the face, of course, by that market crash in 2007 and 8, and literally lost everything at that time. I took out 200 grand on my credit cards to pay my investors back to make sure that they were taken care of, and tried to float in the meantime, and ended up just grinding it out at home, closed my office and everything, and pushed through. And I started doing flips with investors that brought capital to me because they saw what I did for them on the taking the hit side. And since then, we've now flipped over 1,000 houses now. We have over 35 million lent out to flippers, and we've raised over 150 million for multiple real estate projects, businesses, and we invest in notes and mobile home parks and multifamilies and all different types of stuff. And it's a lot more fun than working at a CPA firm doing taxes, for sure, helping the government steal our money. So, it is what it is. But that's how it started. And of course, lots of ups and downs along the way, multiple other punches in the face, people stealing from you in different ways, and business partners are going bad, and all kinds of fun stuff that you have as a business owner that you don't realize. I thought when I quit my CPA firm job, hey, I'm just going to have more time to go to the gym and, have all this free time, and it can be further from the truth, right? It's like 14-hour day later. So, that's how it goes, right? But it's been great. We've had a lot of success, and now we help a lot of people create, financial freedom like we have, and these strategies. I got a 6-year-old and a 9-year-old, and just try to teach them, real estate and education and all the different strategies on, running businesses that I possibly can myself. So my son was super excited about trying to start a business. He wanted to talk about that. I was like, yes, absolutely.
Yeah.
So it was pretty cool. But anyway, so that's the story, man. So I know long-winded. Sorry about that.
No, it's good. And like we really didn't have anything we were planned on talking about. So I just had a bunch of questions from just that story, right? So
Nice.
you're starting over, right? You hit 2007, 2008, you lose the properties. Like, what does that look like? You have to take some time. What did that do to your credit? Like, how did you even like start again after that?
It came down to which one was going to be the greater pain, right? Do I go back to the CPA firm that I literally felt like crying going to that office every day, thinking I can't do this for 40 years. I can't believe I'm good at it, but I just hated it, right? It's monotonous work. And and I took this major hit, and my ego was completely destroyed, right? I thought, hey, I'm a dope business owner. Like I'm a CPA, my books are done, and where there's at least some money in the bank initially for these projects that we're doing, and we're flipping houses. All of a sudden I got a 790 credit score, never missed a payment in my life, and then all of a sudden, oh my God, like I just literally lost everything and had to take the hit, and took it and was just scrounging and dying over here, right? And just the mental hit was tough, but I was like, okay, how do I get out of this? What strategies, what things can I do right now? And I went on unemployment for a while. I was paying myself a payroll. I was trying to apply for jobs, painfully at the same time, going, do I just quit and start, keep doing that? But while
How do you go on pay? You can go on unemployment if you don't have a job, or were you still working for the CPA firm?
So no, I actually paid myself a payroll out of my company,
Okay.
and so I was paying for unemployment insurance and all that stuff,
Gotcha.
consistently.
Okay, makes
So
sense.
I went and did that and was trying to apply for jobs at the same time. I was like, how do I make this work? Where can I get immediate income to survive, right? And I knew I could go find properties because we were starting to find properties, and there was a lot of properties, of course, all of a sudden in inventory out there available. And I'm like, there's a lot of rehabs. How do I structure this and do this? And so I started, a lot of the investors that I took the hit for came back to me and said, wow, I can't believe you took the hit. Like, hey, could you have more deals? We'll invest with you again. And so then I started putting those deals together. I started charging like $5,000 acquisition and rehab management fees included in the cost of the project so that I could keep the lights on. And then so we started doing about 5 of these a month consistently with these different investors. The word got around that, hey, like we've been a good operator and helping them as much as we can. And we started getting more and more joint venture investors to do that with, to be able to, raise capital. We also help run a nonprofit organization called For Investors by Investors that teaches financial education, does real estate education. We've been running that since 2008. And I was going to 5 networking events a week to meet people and meet investors every week for like 2 years, just grinding it out after that, trying to push forward. And we started actually being able to go through and make those acquisition fees consistently, because if I'm doing 5 a month, that's $25,000 a month that, starts to come in for you, in that way to be able to support it. And we just work from home, me and my brother, like grinding it out, trying to push forward. And it was really just grit at the end of the day. And I always looked at people's money as hours of their life versus money. So I've always taken the hit in those ways, which is painful. Will keep you up at night sometimes taking those hits. But at the same time, what you're doing long term for your investors when you take those hits, and you're able to gain enough traction to now where we've raised over 150 million for real estate over the last 18 plus years doing this. So it was a long road. And after flipping 1,000 houses, 1,000 ways to lose money on a house for sure. So, it's a tough business to do for sure.
Yeah. So from, you're talking about 2 different types of market, like before the crash and after the crash.
Right.
How did your strategy change? I'm sure that you weren't buying the exact same type of houses or at the same numbers, or something. There had to be a change, at least mentally. You
Yep.
have to be more cautious. But what was it specifically that you were looking at that changed? I have more free content. So if you're interested, I created a PDF guide and a video to go along with the PDF guide to complement it. And what the guide is all about is the 5 most common mistakes that Canadians make when investing in the United States. So if you're interested in this free guide, go to CanadianInvestingInTheUSA.com/mistakes. And let's go back to the podcast. And it's free.
So before the crash, we were buying properties, renovating them, tenanting them, and then reselling them to investors with no money down. And then we would do seller financing, and then they would immediately refinance on a rate and term refinance and hold those properties long term. And so that was our primary exit strategy at the time, where we would just do that over and over. And we analyzed a bunch of different markets around the country and found, Tennessee markets and Atlanta markets and Georgia markets and Indianapolis and a bunch of these more cash flow markets that we were focused on because we liked the lack of volatility in those markets. 2008, everything had volatility. It went down by 20%, but then it bounced back quite a bit once lending started to come back again, right? And so one of the biggest learning lessons was don't rely on the banks and the government institutions and things like that to actually bail you out or be able to rely on that financing long term. Make sure that you have enough bandwidth on the capital side to, do these things in cash if you had to with investors, and use lower leverage ratios and those types of things, and have multiple exit strategies. So we started going and selling properties to people's IRAs and 401ks and creating the financing, and then selling the notes off to other investors that wanted to own those notes as well, right? We started helping 1031 exchange investors with those same strategies and packaging assets together. We started finding international investors in Japan and China where we set up translation services. We did the international tax research with the tax treaties and everything in those countries to explain it perfectly to them, and so they understand what to do when they're bringing capital into the US and how to get set up here. And for Japanese tax law, they can write things off over 5 years for as far as depreciation. So huge tax benefit for them. So we started these different avenues to be able to show our exits, including joint venture holds, where we would leave equity on the table and have our joint venture partners come in and qualify for the financing for us on 30-year fixed rate financing for the long term. And of course, all of those people were able to refinance and down the line at like 4% rates. And now we're holding all these properties as joint ventures with 4% interest rates across the board. And we have a big portfolio of these types of assets. So these are the different things that we shifted into. And then also it came down to, it was probably the best thing that ever happened to me, taking a hit that early like that, where my ego was destroyed, because, when you learn how to stand back up and you find the path forward, you're like, okay, wow, it's really just focusing on the solution instead of letting your emotions get, a hold of you, which is super easy to do, and it's not easy to do every time, of course, when something bad happens. How do you focus on finding the solutions to those problems first, and just saying, if you write down every solution, you're like, wow, there are options. I can go after 5 different things right here that could potentially solve this problem for me on pretty much any problem that exists out there, now aside from health issues and things like that, of course, which, there's always things that you can't fix, but, it's a matter of trying your hardest and keep pushing, right? So.
Right. And like for the buy itself, were you buying the same kind of properties? I'm sure the price point was different, but did you, change markets? Do you stick with the same markets? Did you, the way you're underwriting it, that change at all?
So absolutely. So first thing is first is we started getting much bigger discounts on properties, and we started working with banks to be able to buy these. We stuck in the same cash flow markets because we really liked those markets. We had the teams established in those markets. Try to set up a property management company in 5 different markets. You got to go through 5 management companies first before you find the good ones, right? So once you have that established team and you've gone through that pain, you don't really like to move that team as long as the economics are still working in that market, as well. And so we're able to go through and start buying better assets for bigger discounts, getting seller financing ourselves from banks. I bought a house that was like $150,000 house, and we ended up getting it for like $37,000 with like $5,000 down with a repair credit and seller financing and all different types of stuff that was worth like $150,000 afterwards, that didn't need a whole lot of work to it. And, I wish I would have saved, held it. It was worth a lot more now. I say selling them 1,000 houses is probably one of my biggest mistakes, because I'd be sitting on $50 million worth of equity right now if I would have held all those and realized, instead of selling for profits, you can just raise capital from investors to hold things long term and take advantage of that inflation and the tax benefits and the debt piece that you can leverage, right? So it's a better strategy for long-term wealth building to do those holds versus flips, So
yeah. Do you see any similarities to like back then when you're starting over to now? Like do you think we're at the bottom? Do you think maybe we don't? I don't really want to go down that path actually about talking about that. But do you see similarities in like the sort of prices and changes, and even myself, I'm seeing like sometimes sellers are more open to things they may not have been open to like 3 years ago. Hello, everybody. Thanks for listening to the podcast. I just wanted to let you know that I've created a new coaching program. I believe the new coaching program has way more value than any of the programs that have even existed in the past. What we've done is pre-recorded all the lessons so that you can work through it at your own pace, which is pretty cool. And then we're going to meet up on a regular basis to answer the questions, do deal analysis, and actually spend our time together working on things instead of spending our time learning things. I think this will make a seamless transition to buying in the United States and will help you solve a lot of your problems. If this is of interest to you, go to glensutherland.com/coaching. I hope to help you guys invest in the United States, and I hope we provide as much value as possible. Back to the podcast.
So I think we have a broken market right now. We have a very big problem with affordability where, interest rates rose, makes it much more difficult for investors to cash flow. It makes it more difficult for buyers to qualify on that affordability level, right? And it pushes buyers out of the market, right? Now, you have a low demand for houses because of the lack of affordability out there. And on the other side of things, you have a very low supply too, lower supply than you even have demand in the first place. And so that's because you have this lock-in effect of a major interest rate reduction where people were getting 3% interest rates. I think it's something like 85% of the mortgages out there have, below a 5% rate. And so if they go try to trade up to a 7 or something from, a 4 to a 7, that's a major hit on a monthly basis. And they're not going to be selling their house anytime soon. And so it kind of have this lock-in effect associated with it, right? Now, we did have a lot better lending this time around. Last time around was horrible lending. Anybody can qualify under the sun. Nowadays, we're seeing no major defaults occurring on the data where you're not seeing, lots of problems on that side yet or anything like that with the economy. They actually had quality loans. People were putting down payments down as well. And so the lending market is a lot different now than it was back in like 2007 and 8. Now, the similarities, I think one big challenge is, in my opinion, in 2007 and 8, that was a liquidity crisis, right? Lehman Brothers moment, big problem with liquidity, and nobody had financing to finance mortgages. Right now, we have banking problems. We've seen some banks fail recently in the last few years as well, right? Because of the change in interest rates that occurred. And in addition to that, their leverage ratios are squeezed on the banking side of things. And we have a very big commercial debt problem with over the next few years. There's a massive amount of commercial loans coming due that were on short-term financing that will not be able to refinance at the same equity ratios they thought they were going to be able to in the past. Now, this could cause a banking issue if there's a major problem here with the amount of debt coming due, which could cause another liquidity issue, which could cause a problem in the single family market or the residential market as well, just because it's going to affect everybody if that occurs, right? So we don't know if that's going to happen. Unemployment's still low. I think the numbers are skewed and the unemployment's higher. And I think inflation is higher because if you go to like shadowstats.com, you're going to realize like the true inflation rates out there. Go look at the price of eggs right now and tell me there's not inflation, so it might be the other factors as well. But, this is my points on the differences between, I think, now and then, or not, now and previously. I don't see having a major crash occurring. I think there's going to be a sideways market for a while, unless there's a major black swan event that occurs with banking or something like that could cause, a major issue or a major unemployment issue, right? Maybe there's a problem in 5 years from now when AI takes over half the jobs, who knows? Unemployment could jump up massively if, Trump lets go 10% of the U.S. workforce. They equate to like 30% of the workforce, the government employees in the first place. So, you have that massive base. If there's a big chunk of that base that gets, laid off or let go or something due to efficiency, there could be an issue. And I'm just guessing here. These are just, ideas and things that you may want to be thinking about when you're trying to determine how you invest, right, in these markets. I still think it's a great time to invest in real estate because whenever there's a lack of supply, you still have this broken market. If you can get good deals right now with some built-in equity on those deals, or that cash flow and your leverage ratios are low enough so you can weather any up and down storm, I do think long term there's going to be inflation no matter what. The government's never going to stop printing money until they break something majorly, right? So I think rents will rise over time. I also think expenses are going to rise over time, like property taxes and insurance. So you got to make sure that you're buying at a good leverage ratio so that you're not over leveraged on a deal if some, black swan event type things could occur, massive inflation.
Well, you just talk about, not being over leveraged on deals. If someone was to be like, if they're in a situation right now where they're starting over, or if they're in a situation right now where they're just starting, what kind of advice would you have for someone who's just getting going or getting restarted?
So real estate is all about resources, and you don't have to do everything, right? A lot of people think, hey, I got to go buy the rental myself and find the deal and renovate it and put up all the money. And the same thing on a flip, right? That's what they think that they have to do most of the time. But that couldn't be further from the truth. You could be adding value to someone else's system if you're going to be active on it. If you got capital and you're just trying to go invest into a property, then it comes down to making sure you know the numbers, right? And the risks involved, right? So know how to break down a cash flow, the cash flow on a deal, and you have all expenses, including a vacancy allowance and repairs allowance and capex for those, and making sure you're looking at all the major systems on the renovation side of things, and that you know what that is going to cash flow long term on your money as a return on investment. There's other strategies where they can invest passively in other syndications, right? There's professionals that are already doing this, that already have all the knowledge base to do it. And so I personally invest smaller chunks of money with different operators in different markets of the country, as well as I actively operate my deals too. And I think it's kind of important for any investor to do both, where you want to have a portfolio of your own that you have complete control over, and then you want to invest with other people that are going to help you diversify into short-term rentals, into debt investments, into mobile home parks and multifamily and those types, where you don't have to do all the work and raise all the money on the deal and qualify for the financing on those types of projects, right? Unless you specialize in those already, because the learning curve is really high in real estate in the beginning. You do one flip and you go to Home Depot every day and you start checking all those prices. You start learning the problems with contractors and the lack of education with certain realtors out there and stuff like that. You learn a big lesson. So I would say learning, understanding how the math works, how to find good deals and what that looks like, how to raise capital for projects and stuff like that as well. And that operational expertise is the key if you're going to be actively involved in these. If you're going to be passively involved and you just want to put money somewhere, know how to do your homework on an operator and understand, all the list of items that you have to do. We have a due diligence checklist on our website we use for all of our deals. It's a 200-point due diligence checklist. You go to MathewOwens.com with one T and Matthew, you can download it for free. But we use that for all of our deals, just to analyze those and make sure we have a bunch of questions for the operator, a bunch of questions for the legal documents, a bunch of questions for the market and the financial model, and all those different pieces that you really need to know, the financial assumptions that they are working with, and to see if you agree with those, right? And do your homework on those people before you invest, because you don't want to invest with anybody without doing background checks, criminal checks, getting references and all that stuff. A lot of people are lazy and don't do it, and they absolutely are causing themselves losses in the future for not doing that stuff, right? So
Yeah, totally agree. You just mentioned some of your resources there. If people were trying to get a hold of you, they wanted to know about your business, they want to know about anything you're doing, where do they go to find you?
yeah, so they can go just to my website at MathewOwens.com. One T in Matthew. I say my parents couldn't spell, so even though he was
No,
a
no, I've seen it spelled that way before.
So yeah. So MathewOwens.com, and then we have that 200-point due diligence checklist. I got a quick analysis sheet on there where you can plug in 5 numbers and know if you have a deal or not on a flip or a hold. And then we have a master class on how to analyze deals, how to find deals, how to raise capital for deals as well. So those types of things you can learn for free from us. And I used to sell the real estate courses. I just give away the courses now. It's just not worth, sitting there for 6 months and training people like that is a lot of work. So yeah.
Awesome. No, Matthew, I totally appreciate you coming on the show. I think people who are either starting over or getting going, some value there.
Awesome. Anytime I can help. Appreciate the help. Appreciate the discussion.
That was a nice video. Bye.